Welcome back. Now, state-owned enterprises have been viewed as persistent liabilities, weighing on the country's credit profile. But South Africa's debt capital markets are undergoing a transformation, signaling a potential shift in the investment environment. Credit analyst at Prescient Investment Management, Michelle Green, joins us now to unpack the impact of reforms on SOEs and shifting credit dynamics. Thank you so much for your time, Michelle. Now, before we actually get into the impact of this kind of gear shift that we are seeing, how attractive has South Africa's debt capital market been for both issuers and investors?
Certainly, thanks so mumuch for your time, but there certainly seems to be a shift in investors' participation. There's still a lot of capital in the system. It's certainly an attractive investment class from a credit perspective. Investors are participating quite significantly, and we see this in the oversubscription of auctions when issuers are coming to market. So there definitely seems to be an appetite for credit, investors looking for whether it be pickup of yield and definitely at play for diversification relative to government bonds or something else within the space. So from an appetite perspective, attractiveness, there definitely is still a lot of appetite in the system.
All right. I mean, just drilling into the details in terms of the drivers then of our improving credit worthiness. Let's start off with the transformation in the energy sector. Are we out of the woods?
Wouldn't say we're out of the woods. I think we are making headway, particularly in the energy reform. Just looking at it from a standpoint point of view, like if we're looking at January earlier this year, we looked at the Energy or Electricity Regulation Amendments Act that got passed through, and that is a game changer. It literally lays the groundwork for having a competitive electricity market. And it also formalizes the unbundling of ESCOM. So we're already starting to see improvements come through, both on an operational perspective, but also on the financial perspective. So we've seen, the reduction in load shedding, and this is certainly as a result of the energy availability factor that has actually increased. So these operational improvements, we've seen the debt relief package, which has helped them operationally. We're seeing support internationally as well from the World Bank. And this is all to unlock basically the infrastructure spend within the energy space. So from a reform perspective, we now also can see more predictable revenue streams, because that's now also regulated. So we're making headway. It's looking positive. The REAP program as well. I mean, we've been able to achieve over 6,000 megawatts in clean energy capacity, over 100 projects. And so that's quite positive. And investors, now that we understand the program, there's a lot of appetite out there, and that continues.
Well, it seems that we moved from one Achilles heel to another, from energy to logistics. Of course, we know the problems that we've had with transit, but actually quite interestingly, we've seen a lot of the miners that have been heavily affected by the logistical challenges actually saying in their results commentary that they have seen improvements there. So, but I mean, really what I want to ask is that, is the logistics reform agenda moving at a sufficient pace? Because it seems that there's a little bit of cautious optimism.
That is definitely the case as well. It's definitely lagging behind relative to the energy reform. There's still a lot of work that has to be done, but there is progress. That progress is visible. We are starting to see some green shoots in the logistics space. If we're looking at Transnet recovery plan in particular, that focuses on third-party access to rail, port corporatization, for example, that signals structural shifts. Obviously, execution remains a concern because they're sitting with aging infrastructure. There's still governance issues that still needs to be worked out of the system. They have a negative free cash flow as well. That's still significantly weighing over and above 132 billion rand of debt bill. But the green shoots are there. We're starting to see volumes in terms of their cargo that's increased 5.5%. Yes, it's not at the target, but we are starting to see improvements, and that's ultimately what held them back as well. So from that perspective, it's looking positive, green shoots. They've also recently announced that from a governance perspective, they have another subcommittee that they've now introduced sitting below board that is going to give another oversight in terms of meeting milestones and ensuring that the recovery plan actually goes according to plan. So over and above that, we're also starting to see, there is investor support that's improving. Transnet alone has been able to actually raise government guaranteed in the market over 2 billion rand earlier this year. So that's actually, it is positive. It is not at the pace at which we'd hope, of course, and they do rely on government guarantees. And in July now recently, government came out to say they're giving them almost 100 billion rand in additional government guaranteed facilities, and that's for the next 5 years to basically ensure that they can meet their maturities that come up. And giving investors a little bit more comfort around their liquidity risks that has been put out in the market. So from an operational perspective, green shoots, execution remains still a very key concern, and we're watching it quite closely.
And that's the thing. You mentioned governance, because we know that it's not just about sorting out, shaky financials. Financial resilience actually needs to go hand in hand with correct governance. So what are the main weaknesses here that we should be looking at and trying to sort out? What gaps need to be closed here?
I think first and foremost is actually to get something that is quite clear from a roles perspective. So governance, making sure that there's line of sight in terms of who is responsible for what, how pricing or tariffs is determined, ensuring that could potentially be regulated, much like similar kind of concept to what we've done with the REAP program. I think that is a program that all the investors are comfortable with. It's why change something that does work, try and apply it to something of this magnitude as well, and then apply its nuances. I think that we shouldn't change necessarily and create complexity where it doesn't necessarily need to, but rather to strengthen what we have and bring along the private sector. And ultimately, I think that will open up the gap. So it's focusing on the governance, focusing on investing capital into the aging infrastructure, making sure that is ultimately sustainable, because we don't want quick fixes, right?
Yes.
We want it to be sustainable so that the knock-on effects on the economy, on other businesses, we can start seeing activity take place. And so what we want to start seeing and what that will enable is a state-owned entity that is self-sustaining and doesn't rely on government or the fiscus for that matter.
And just lastly, Michelle, as we wrap up the conversation, with these recovery and growth drivers that we've spoken about in these critical areas, what opportunities then does the debt capital market offer for both issuers and investors?
That's a very good question. I think it's quite diverse. I mean, we're seeing strong momentum, particularly in the infrastructure space and the green finance space. And we're also seeing SOEs starting to diversify their income revenue streams, investing more in resilience and tech, and partnering with the private sector. So that's quite positive. Looking at Eskom in particular, they're shifting focus from transmission, for example, Transnet now focusing on corporatizing their ports, for example. And then, of course, the REAP program that has a significant pipeline, that's opening new investable pathways for institutional capital, ultimately. Over and above that, earlier this year, actually, the president said that 940 billion rand is going to be allocated for infrastructure spend. Almost about 400 billion will specifically be allocated to state-owned entities, and that is for roads, bridges, etc. And that could unlock even further opportunities within the credit space, both from a borrower and a lender perspective. And then, of course, having the World Bank come on board as well with a 500 million rand credit guarantee could also give us as investors the international validation to further, invest into the space. So there seems to be quite a lot of opportunities, and particularly for institutions where they have mandates that's either ESG or impact or infrastructure-led, that could also open up further capital. And I think ultimately it will be positive from an economics perspective, because not only are we going to be meeting the infrastructure needs that we so really need, it's going to create jobs, we're going to stimulate the economy. So I think it's a win-win on both sides. But what we need to get right is the reform, making sure that implementation is done, the pace is picked up, but it's done in a way that is consistent. There's transparency. The private sector is actually coming on board with that walk to ensure that everyone is comfortable around the table.
Well, thank you so much for your time. Really appreciate your insights into this agenda that is very, very crucial for our economic growth. Really appreciate your time, Michelle. That was Michelle Green, credit analyst at Prescient Investment Management.